Structures?
Yeah, I would like to know.
Let's do lending. Lending. All right, so we're talking about lending. We're talking about lending practices in terms of what you can do with all different types of borrowers. This is just an outline of the borrowers that we work with, right? Most of the time it's W-2 salaried employees. We are independent contractors, so how do you get approved as an agent? And then corporate, like a business, S-Corp, which you can turn a 1099 into an S-Corp, which I'll talk about, by the way. Okay? So and I'll explain my example, which is how I bought my house in Upper Saddle River, which was we did a 30-year conventional fix, but we did what's called a 10 and 10. And what that is, a 10 and 10 loan. So basically, I knew that, okay, so I wasn't, and this is great, by the way. This is great for two different types of buyers. Ones that need to sell, but don't have to sell simultaneously on the same day. So you have current sellers, right? So like they can go a few months without it being sold. It's okay, won't break the bank, but they have to get it sold within like a 6-month period, let's say. Okay? So current sellers, future seller, whatever. You're a seller, this is a great program for you to still buy if you need the cash. But you have to have 10%. This is 10 and 10 is 10%. So how I closed that loan was I closed, so to the seller, right? Because no one's going to accept the deal now with 10% down, for the most part, if you're competing with multiple offers. So this is a way to, do it creatively, where you present, so you present with your offer with 20% down. That's assuming they have access to 10% later, obviously. It's like 10 now, 10 later kind of thing, right? So what we did was we closed with 10% down. And then we took out what Barrett was talking about, basically a bridge loan for the other 10%. So the seller got the full 20% at closing. So nothing changed there. So what this is, this bridge loan, and they have like all different interest rates, doesn't matter. It's like I got mine at it was like 5%, I think, of an interest rate for this thing. But it doesn't matter, because if I choose to pay it off or I don't, whatever, it doesn't matter. And that's the thing, that's the beauty of this too. You don't even have to, so you don't have to pay it off. I'm not going to pay it off. Now I have literally an extra, whatever, 100 grand that I can play with now. I don't even have to worry about that money. So that's how this is a beautiful lending program for 20% down or more. And every one, like Barry was talking about bridge loan, that's what I think that's what I believe he is talking about. So that's just a creative way to do it. We'll go to questions later, but that's the crux of it. And you don't have to pay this back. You don't have to pay when you get funding. So what worked for us is, like, obviously we're selling our Cliffside Park house, right? If I chose to pay it off, I could pay it off, right? But that wasn't the point. The point was that was the point originally, but now we decided that it doesn't make sense, and we're going to just keep the 10% equity in the property, and if we have this other loan now that I'm going to be we just have in the corporate account and use for the business. So it actually worked out perfectly. So I made the offer with 20% down, but yet I only put 10% down. And I have another 10% that I'm putting right back into the business as a loan, just from a purchase of a property. So you can do whatever you want with that, however you want to do it. I'm just giving you my example, and that's how I thought about it. In terms of like credit and what you're looking for, right? So you have different things that you have to look for. Credit, debt to income, and you can talk about all this stuff with them. There's no reason that you shouldn't talk about this. Reserves, and what I mean specifically, after down payment, employment history. I mean, I think you guys know all this stuff. If you don't, it's fine. We'll talk about it later. Employment history. Wait, so on a W-2, which is going now back to what the borrower. So if you're on a W-2, and that's what their job is, if they don't have at least 2 years of history, they will not get approved. Okay, W-2 needs to get that. 1099 now, as far as employment goes, they want to see at least 2 to 3 years of returns that you have. So if they want to get basically like a 2 to 3 years of returns just from your 1099. And actually, they didn't even look at, like, at least Chris Gallo did. I mean, he didn't even look at my my corporate account. He just looked at the 1099, just so he was like, okay, fine, like whatever, like we'll just approve it. But that is kind of risky in my eyes, because what if I was a gambler or something, and I was like just crazy, and I just wanted to, you know, I wasn't good with money, and literally, you know, he literally approved me for $1 million loan to, you know, not even look at like this. So you can get away with it. It's very loose right now. So just keep that in mind. The lending standards are super loose. Credit now, you can get good rates still, like at 660 is where it starts from there. I'm talking like a lender. Debt to income, you want it to be at least 40%. If it's higher than 40%, no go. If it, you know, because, and you can ask these questions to a buyer if you're getting to that point. If they have questions to you that you want to ask. So it'd be like, hey, how's your credit? You don't have to tell me, but is it above 700, below 700, above 650, whatever? Debt to income, do you know what that means? Do you have any reserves after your down payment to show? So what I had to do is I had to show, so they did this, but I also had to show my, I had to show reserves, but not as much as you think. They only look for, I mean, it was crazy. I showed them one account. I had like multiple accounts and all different things like Robinhood, crypto, this and that. And they only just looked at my Robinhood. That's all I showed them, which was like under 100,000. So they just, you know, it's really not as bad. You don't have to show like everything that you have. So, I mean, I think people get a little bit weirded out. They don't want to show everything. So if they are like super wealthy clients that you're working with, let them know you don't have to show everything. You don't have to show everything. Okay, and then the people that are also scared about like certain things, whatever, you know, like you know, in terms of their identity and stuff like that. So, but this would really also help you guys, I think, get more offers accepted, because now you can speak to this when you talk to listing agent. Hey, not only do they have a full, because I mean, look, we talked about getting a full file on the buyer, right, or talk to like the lender, and we call it what's called a full file. So they have all these things checked off and actually accounted for. Is that in the pre-approval? A lender can just simply say yes. That you don't know, but if a buyer tells you, oh yeah, my credit score is above 700, my debt to income is above 40%, I mean, or below 40%, I have 6 months in reserves, which is what they look for, by the way, after the down payment, employment history, I've been working there for at least 2 years. Okay, great. Now, wouldn't that help your offer in a multiple bid situation? No one has that information. No one would even feel comfortable asking that question. But what do you care? You're the agent. You're the pro. Be like, hey, look, if you don't want to feel comfortable talking to me about this stuff, totally get it. But since we're such a competitive market, I just want to make sure I have all the information that at my disposal to get your offer accepted. And this is a way to know that you're going to close. Because a lot of deals fall apart in the middle of a return review because of cold feet. They think that they pay too much or whatever. So it's just another way to look at that. So let's talk about litigation. Joey, I know that they're not supposed to talk, but I just want to ask this one question. Just a yes or no. Do you guys ask the question to listing agents, do you know if this building, if it's a condo, is it litigated or there's any assessments going on? Yes or no? Yes, yes? Never had a chance. Fine. The answer is yes. Good. Okay. Assessments. This is now building now. We went to the profile of the buyer. This is litigation and assessments. Okay, there's two different kinds of litigation. If you guys don't know this, no big deal. Structural and transition. Structural is what they go for. That's where the condo association can get the most amount of money into a lawsuit when they sue the former developer. There's also a 10-year window after a building is built that you can sue the former developer. After that period, statute of limitations kicks in, they can't sue. That's why every condo building, if you notice that has been built in the last 10, 15 years, there's some sort of litigation or something going on. Why? Don't you see that's kind of weird? Well, why is that the case? Because of this. And the way that, so they always try to go for this because this is the most money that you're going to get, but it's usually transition. They're transitioning, there were a few problems, it's transition litigation, okay? But keep that in mind. These are all facts and figures that you can know to how to get lending to know what you have to do. Now, what does this mean to getting approved? So, like Barrett, I mean, litigation, as long as the buyer has great credit, good debt to income, and good reserves, 10% down. You could do this. You could do this for 10% down. It can happen, yes, but it has to be A+ on all 3 items. And then if it's less and it's only a good credit, then you go 20% down or more usually. But everyone's got a different way of how to look at it. They're all looking to get creative on that side of it. So that's just litigation. And then for assessments, this eraser sucks. So you have assessments. Basically, you have any type of assessments, right? So one thing is, what's an assessment that kills the lending? There's really no assessments. I don't know if you guys know this or not, because in fact, some buyer's agents have actually told me that they ask the question like, "Oh, I don't think my buyer can get approved." I'm like, "For what reason?" And agents actually ask me this now, because there's a big assessment in the building. There's no assessments that can actually kill a deal, unless it's no assessment kills a deal. Unless, of course, the buyer's situation is so bad that there's something going on there. Just pure facts. Has nothing to do about, it's actually the opposite of what it used to be, where they would just give a loan to anybody and then they wouldn't lend because of an assessment or litigation. It's the opposite. They'll loan on anything like this now, and it's actually the buyer's profile, credit, that's the only thing we just talked about, that gets them accepted or not. So that's just what I know. Yeah, so that's pretty much what I think we have for today that I want to talk about.